I have lived long enough to know that opportunities must be seized or they will be lost.
Hello and welcome back to Wall Street Radio. I'm your host, Tanner Yarton, here with Dan Young. And in this episode, we're going to be talking about the market's reaction to NVIDIA earnings and everything that comes of that. So we're going to be talking about growth and how it's been impacted by a large market sell-off. We're going to be talking about our latest article, the infrastructure article, which covers a potential trade in long infrastructure in the event that the market does correct, or we do see some economic slowdown based on Trump's policy and recent uncertainties within the market. Enjoy.
Well, happy Friday, Tanner. It seems like we weren't so off on the opinions we had recently.
Would you look at that?
Would you look at that?
No, that wasn't a crazy read, to be completely honest with you.
Everyone
I think you and I both know that.
Yeah, everyone was expecting it. Let's jump right into it with NVIDIA earnings. So they reported $39 billion for revenue. Oh, pretty light, in my opinion. I would think the market was expecting 43. And that's like, right. So when I say that there are different estimates, I think the combining of like where their growth trajectory was, as long as, with the saturation and fluff in their price, I was expecting 43. I know a lot of other people that were expecting around that 42 to 43 range. And so 39, while it's not technically like a big miss, and it's still very like healthy growth for the company, obviously, the problem with it is that you start baking all of this price saturation and all this hype into growth stocks. And at some point, like Cisco and, back in the 90s .com bubble, they don't become growth stocks anymore. And so the first time, and we saw this a lot in 2021, the first time any growth stock does not represent growth anymore with their earnings, there becomes fear and risk that, what if they miss next earnings? What if this doesn't become, or what if it doesn't continue to be the NVIDIA that we knew the past 3 years? And so that, in my opinion, is the fear and concern. And that was always like the domino that could fall, which is what if the market starts believing that the slowdown is here and it's real? And it's like, it's like in the movie Margin Call, like, did the music stop playing or has it already stopped playing? I think this was one of those things where people are now starting to listen more intently and say, is the music actually still playing or are we screwed?
Yeah, it's certainly much easier for people to start listening to that type of stuff now that NVIDIA has reached a point of value where the surprise would have had to have been huge to keep this train going. And this is a conversation I had with somebody at the gym yesterday, of all places. When something's growing, people are surprised by the growth. And surprise always leads to a drive in share price because price is trying to price in that growth. Well, after 2 years of NVIDIA surprising the market with how well it's doing, we've reached a point now where they're just no longer surprised. So even though the growth is phenomenal and year over year and quarter over quarter numbers are great, everybody expects it to happen. So when it does, they're less surprised than, say, a year and a half ago when it was like, oh my gosh, these guys are on pace to do 100% year over year for 2 years in a row, right? So
yeah, that makes sense.
So I think there's a point in time, and now pinning that exactly to the quarter is sometimes difficult because even, you look at like AppLovin, right? I wouldn't have expected AppLovin to continue to grow the way that it was, but they continued to surprise, and that led to large gaps quarter over quarter. Whereas with NVIDIA, it's like we've been consolidating here for 3 months now. This quarter would have had to have been a blowout to get us out of this large range. And the fact that it wasn't, despite good numbers, just means that people are exhausted, right? Who's here to buy it at these prices? Because it's easy to surprise and people are still interested when the multiples make sense. But it's like, okay, we've gone on for 3 quarters here where the multiples still haven't made sense. Nobody is there to buy it anymore. There's no new investors waiting to get into NVIDIA on a good report.
Yeah. And so as soon as that report came off, there was mixed earnings with the stock price itself. It went up, I believe, to like 135, 136. I was watching it pretty intently because I was actually thinking about shorting it. I never did. I sat on the sidelines most of the day with it, but it hit around 135, 136. It dropped pretty quickly to 128. it then went back up a couple hours later. I mean, heading into yesterday's session live, it was around 9:30, like 135, 136. It had made its way back up from the reversal. And it was interesting because the market usually it like didn't immediately react. And so what you ended up having is anyone purchasing leverage through options like puts or calls, they were just going to get nuked on those as the premium got crushed. And so that was an interesting thing in my opinion, is they just really like stabilized price to crush all premium. And then intraday, we saw a slight sell off to around like 130, 131. And then the floodgates really opened around noon to 1 o'clock. NVIDIA really started hitting the hay and the market followed. So the S&P closed and started really having some larger liquidation events. The entire market in terms of tech and growth was getting hit very hard towards the end of session yesterday. So looking at that and looking at the market as a whole, I started adding small bites of long value tech names that I like around 355 yesterday, just because they already were reversing their gap ups from earnings. They're now below their 50 SMA. Historically speaking, like if you're going to DCA in any position, like these are times when I've frequently have seen that you want to start taking some bites, because the market can slingshot as fast as it goes down. And the last thing I wanted to do was miss out on some lower entries and wake up today with the S&P up, back 2%, which could totally happen, which again is like one thing we'll talk about. But how are you approaching this? Like, do you think this is a viable dip?
Yeah, so as far as my type of strategy goes, which is more momentum based, there needs to be momentum in the market, obviously, for me to want to be participatory. And right now, what we're seeing is a large softened broad market, which basically double dunks and makes it even worse for growth names, which is the majority of what I trade. So as it stands, the only value that I'm looking to buy is in the independent power producers, the more defensive names in the electricity value chain. Whereas the high momentum kind of volatile stuff is going to need to set up again. And what's going to need to happen is it's probably going to need to bounce off these lows and then give me some kind of enterable setup before I want to get active again in that market. So I guess right now, while I am looking for value in a few key spots, the majority of what I'm paying attention to is just getting absolutely slammed. And that means my book remains primarily cash right now.
Got it. One thing I did want to talk about as well, talk like growth and all hype stocks and how they will perform during market pullbacks. IONQ was one quantum name that has been really hype lately. I was watching their earnings call and watching the price, and that thing there were so many problems going on with that. First and foremost, anytime a CEO steps down abruptly after like a monster run in a growth stock, huge red flags. And then they come out and they give their guidance for Q1 and they slash it from 16 million to 7 million, but they're keeping their full fiscal year guidance. And I was like, that is such a bad omen for the entire market, because trying to make up dollars in Q2, Q3, Q4 that you missed and you were supposed to have fully funded in Q1 and like fully baked, like that is such a big miss. And so that's part of what I think could potentially landslide growth stocks in the market. And generally, like if things with value slide with the overall S&P, and then you have a lot of this like growth hype start to slip, and that their earnings aren't going to be what they think they are, the revenue's not going to be what they think it is, that's when things can really start tumbling fast. And so I thought that was just a good example of a growth stock that has gone, oh man, what, like 10x? Has it gone 10x yet? At least like 6 to 7x in the past.
IONQ?
Yeah.
Oh yeah.
Yeah.
I would say it's more than that. I mean, some of these quantum names are up 3,000%. Yeah, IONQ did 700%, so it did a 7x. Yeah.
Yeah. So you have that, and then I mean, if NVIDIA is going to sell off on really strong quarter over quarter, year over year names, and it's not living up to the hype, what's going to happen to these smaller names that can't even produce $7 million in Q1? Like that's absolutely nothing. That should be free. So I'm interested to see what happens to a lot of the speculation that has been driving the market and driving the hype. And that's usually one of the telltale signs of a market cooling or a market pullback, whether it was GME a couple years ago and all of the, the hype and the meme stocks that were running, that signaled and triggered much of what we saw in 2022, which was a cooling and a slowdown back to par value. We saw that actually the past couple months. I think a lot of us just got blinded to it, whether it was AI, whether it was quantum, whether it was nuclear, like a lot of these things that really are not like fully producing the way that they should yet from an earnings perspective or revenue perspective. They were getting a lot of speculation, really driven off AI, obviously. But the AI wave could have been a trap, right? It's very future looking. It's not concrete. It's not stable. So like anytime you have a sell off or anytime the market wants to induce more risk and more fear like into the market itself, you're going to have that sell off in things of the future because they're not real yet. And people, right, they invest in what's real. They invest in what's here today. And that's why infrastructure is like a huge part of where money is being driven right now. Same thing with healthcare. And so you wrote a really interesting piece yesterday about infrastructure and a potential trade if the market really resets from some of Trump's behaviors, but the way in which we talk about like the Federal Highway Act and different things that could come about when we have periods of stagnation or really low employment in the US. And we've now seen the government jobs open up dramatically. We've talked about software engineers being laid off left and right. Their layoffs and unemployment are increasing every day and every week.
If the market cools off and the economy slows down, what is Trump going to do to pull us out of that? We know from history that Trump is extremely closely tied to the performance of the market. I remember back in 2018, 2019, the market would be down on the day and he'd get on a presser and just start talking about how great the U.S. economy is to kind of boost the number a little bit. And that's a known fact. So if the market does slide, we do get some kind of economic slowdown because, for what it's worth, his policy, like we talked about even before he got elected, is kind of counteractive to a strong market. We knew that the bigger players, the more globalized players were going to get hurt by the tariffs. With that in mind, it's like, okay, so if the majority of his policy is going to hurt the market, how is he going to keep the market strong? And I think that comes back to one of his original points from his first term, which is infrastructure, bolstering the United States infrastructure. I don't think it's any surprise to anyone when they go to other countries around the world, especially like a Japan or a South Korea or some of the European nations. Train infrastructure, railway infrastructure globally is definitely better than it is here in the States. We're not huge fans of public transport here, but maybe that's just because we don't have all that great of public transport. So I think there's a potential trade there where Trump is going to stimulate the economy in infrastructure to not only bring jobs, but also to increase productivity in the United States and also bolster what we have domestically in the event that he does bring a lot more manufacturing back to the United States. Because you can't bring manufacturing back to the United States and then not make our infrastructure to support that manufacturing better. So I think there's a possibility that he does start to bring a lot of money into some of these sectors and industries to boost our domestic economy and push the stock market higher. That's kind of how he's operated in the past, a little bit of supply side economics, and we'll just have to wait and see. But the article essentially outlines that thesis, especially with the idea that AI infrastructure needs to build out. If we want to remain competitive with China, we have to spend there anyway. So it kind of makes sense to add in some of his broader infrastructure plans for the United States prior to all this AI stuff back in 2016 to 2020. Then add in the cybersecurity piece as well, which is another key point of the article, in that if we're going to bolster AI and spend more on that to kind of improve the operation here in the United States, well, we're going to have to improve security as well. Because if the good guys are getting better at AI, then that means the bad guys are getting better as well. So not only are we going to have to spend to improve our offense, but we're also going to have to spend to improve our defense. I think there's a lot of opportunity within that trade. Right now, it's a little bit muddled because we're not sure on the exact direction that he's going to take, since he hasn't really spoken much about this yet. But when that becomes more clear, I'm going to be prepared to get long on a lot of that stuff.
So in there, you talked about a couple different companies, right? One of them being SpaceX. In terms of that and the infrastructure trade, like talk to me about your thoughts there.
Yeah, so of course Trump is going to help the people that are closest to him, and Elon Musk has great proximity to Trump, and we're already seeing that play out. It looks like the FAA is going to lose a $2.4 billion contract with Verizon, and they're going to give it to SpaceX instead. And that's just, that's classic. You help out the people closest to you. And of course, Trump is looking to oust Verizon and bring in Elon Musk's company. So I think there's an opportunity in SpaceX there, in the sense that if we do want to improve our space infrastructure, then we're going to do it with the people that are most closely related to Trump, which is Elon, which is SpaceX. I think there's a trade there. And then also there's spillover. So if we're going to continue to push this kind of idea that Elon Musk is going to Mars, well, you can't just show direct favoritism to Elon Musk without giving, some crumbs to the rest of the group. And that's where Lunar, Intuitive Machines, and Rocket Lab come in for me, both of which at the current moment are fairly overvalued. There's no doubt about it. But in the event that we do start to spend on infrastructure, you and I both know what happens when the government starts to spend on anything. It's incredible what a stock can do when the business starts to get some funding from the government. So I would anticipate that some spillover from SpaceX funding does go into some of these more tangential names, and those all start to boost as well.
Yeah, this is just going to be an interesting time to watch the infrastructure trade, especially with the markets pulling back, because a lot of these names like Caterpillar, John Deere, anything in construction, building materials, like if there is this sweep, if they're able to hold their price and be steady while growth sells off, and just by happen, there seems to be these tailwinds into infrastructure and like supporting manufacturing at home, they could see historic gains. Like the Dow Jones would become... Yeah, it would be hyper growth for a lot of these names because they're holding so much value intrinsically. And then you have a lot of hype behind them, which would be really interesting to see. Like to see speculation with stability in the market would be a really cool thing to watch. So it's going to be Friday. The market opens in 30 minutes. The S&P is stable right now. I think it's up maybe like 0.3 or 0.4% after the sell-off yesterday into close. Are you purely on the sidelines? Are you looking at names now? Are you even going to look at the market today? Like, how are you looking at the book?
Yeah, so I'm certainly going to be shopping around a little bit, in the sense that I do want to see where things are falling. SPY has now fallen all the way down to the bottom of its longer-term range since the election. So if we're going to get a bounce, maybe not a big one back to all-time highs, but if we're going to get any kind of bounce here, it's going to be right at this spot. So I want to see where some of my favorite names are, just as far as off their high percentage goes. If any of them are hitting some long-term supports, there might be some dead cat bounces to take advantage of there. Some undercuts and rallies through previous supports. And again, not drawn out trades, but some kind of bounce action. For the most part, though, sidelines.
Yeah, I think I'll be on the sidelines as well. The big thing for me is just making sure I understand, again, like what my risk is, what my cash level is, and names that I want to be involved in. And I don't want to be hitting myself in a week if the market recovers and everything is up another 5-6%. Like I want to make sure I'm in position to take advantage of a move like that, not only short term, but long term, while also mitigating my risk with the book.
Yeah. And I'll probably have to shift focus a little bit. Again, as a momentum trader, I have to be focused on the top thematics. Well, if those themes are all getting slammed, the money is going somewhere, and it's going to be about finding those. So maybe it's not in the AI, robotics, space, nuclear themes, but there might be some other themes emerging, and it might slow down my equity curve a little bit, but worth finding that value if it's there. So yeah, we'll just have to wait and see how this day goes. I don't have anything else for this episode if you don't.
Yeah, that's it. Short podcast. Everyone, keep your head on a swivel going into Friday's session. We'll have another podcast coming out soon, just looking over today. I think today is a really important day in the market, and we'll have to assess what happens and where price flows. But that's it for me.
Yeah. Oh, one other thing to add in. We did add a section on the Substack for podcast itself. So if you're a Substack reader and you go to other platforms to listen to us, you can now listen right on the platform. So definitely check that out. When you click on our homepage on Substack, it'll pop up as Wall Street Radio. There's a little section there. You can click on it. You can subscribe, download episodes directly, or listen to them on platform. Goodbye.
Now watch this drive.